Donald Trump just lashed out, and U.S. stocks just dropped hard. What he said is shaking portfolios. If you own equities, your net worth may already be bleeding. But what if this is your moment to act, not just survive, but come out stronger? Stick around. By the end, you'll know exactly where to position yourself and where to avoid. Markets hate surprises. And when a political heavy hits the stage, the tremor spreads. But here's the critical truth: the fear this moment creates is your opportunity, if you know how to read the map. Yes, I know, the stock market stress is making your heart do cardio. But trust me, we'll get to the good stuff. Let's frame this in 3 acts. Act 1, the wild lash. Act 2, the market reaction. Act 3, your move. Ready? Let's go. First, what exactly triggered this sudden shockwave across the markets? Former President Donald Trump reignited tensions with Beijing, accusing China of manipulating rare earth exports and threatening what he called, quote, massive, never-before-seen tariffs. According to Reuters, he even cast doubt on whether a much-anticipated summit with Xi Jinping would happen at all. No briefing. No build-up. Just one fiery statement, dropped in the middle of a fragile market week. That's what analysts call a policy shock, when words alone move billions of dollars before any law even changes. Investors were already jittery over inflation and supply chain fears. Then Trump's warning hit, like gasoline on smoldering coals. In seconds, the narrative flipped from optimism to panic. One tweet. One threat. And Wall Street got a wake-up call. In short, the market just had a heart attack. But make no mistake, this is only the beginning. Because in Act 2, we'll see exactly how Wall Street responded and what that means for your portfolio. Spoiler alert, it gets ugly. Point 1, the plunge. Within just hours of Trump's remarks, the markets went into freefall. The Dow Jones dropped nearly 900 points, down about 1.9%. The S&P 500 lost close to 2.7%. And the Nasdaq, the tech-heavy index, plunged roughly 3.6%. That's not a routine pullback. That's a flash crash. Tech stocks were hit hardest, especially the ones tied to China or global supply chains. Semiconductor giants, hardware makers, even EV suppliers, they all got slammed. Investors didn't wait to see what happens. They ran for cover. Yeah, your screen probably looked ugly. So what caused it to get this severe? Let's dig deeper. Point 2, why it got this bad. First, valuation. The S&P 500's forward price-to-earnings ratio was already sitting well above historic norms. Translation, markets were priced for perfection, and perfection just got punched in the face. Second, political risk. Every trader knows, when politics enter the chat, volatility follows. Markets hate uncertainty. And Trump's sudden tariff threats? That's the purest form of uncertainty there is. Third, exposure. Too many companies are over-leveraged to global trade. You disrupt one supply chain, one tariff, and the whole system shakes. In fact, just in March 2025, Trump's earlier tariff talk erased an estimated $4 trillion from U.S. market value. So this weekend's move? It wasn't random. It hit a market that was already standing on thin ice. And that's why the drop was so deep. But the real story is what comes next. Point 3, the ripple effects. When markets tumble this fast, it doesn't just stop at losses, it feeds on itself. Margin calls start rolling in. Traders are forced to sell positions they didn't plan to touch. Volatility spikes, hello, VIX. Confidence breaks. Even companies that have nothing to do with China get dragged down, simply because liquidity dries up. Big institutions, hedge funds, mutuals, pension money, start pulling risk off the table. They rotate from growth into safety, cash, gold, utilities, defense. And when that rotation starts, it doesn't end in a day. It can last for weeks. Sometimes, months. Some strategists are already warning, This could set the stage for a deeper correction. Maybe 5 to 10% lower than where we stand right now. But here's the key, not every stock will suffer. Some sectors could quietly turn this panic into profit. And in Act 3, I'll show you exactly where to run toward and where to run from. Now, how do you protect and prosper in all this? First, move toward protection. This isn't about panic, it's about positioning. Start by trimming exposure to hypervolatile names, those moonshot stocks that ride headlines instead of fundamentals. Shift some capital into safe harbors, utilities, consumer staples, and high-quality dividend payers that keep cash flowing no matter what Washington or Beijing does next. And yes, consider light hedging. Low-cost index puts or inverse ETFs can cushion the blow if markets lurch lower. Just don't overdo it. Hedging is a shield, not a sword. No, I'm not saying bury your cash in your mattress. But you do need a cushion. Second, let's talk opportunity. When fear takes over, the market misprices everything. That's where contrarian opportunity lives. Look for strong companies with fortress balance sheets, global moats, and pricing power. Names that got unfairly punished, but still own their market. Also pay attention to who wins when tariffs rise. Domestic manufacturing, rare earth mining, defense suppliers, and reshoring plays. These sectors often turn panic into profit. Set your buy zones, your limit orders, before emotion clouds your judgment. In times like these, patience pays more than speed. Third, time is your secret weapon. Don't expect a straight recovery. Volatility will linger, headlines will keep swinging. But if your horizon is months or years, these dips become your best entries. Review your allocation. Check your cash buffer. Know your position sizes. Because when chaos hits, discipline, not emotion, builds wealth. One market drop won't define your future. Your reaction to it will. So that's your playbook. But what if the drama continues? In summary, Trump's lash triggered a sudden policy shock. The markets responded violently, valuations reset, panic spreads. But inside that chaos, there's order. You choose your direction, defensive, opportunistic, or disciplined over time. You could watch this all unfold and be crushed, or you could watch it, learn from it, and let it shape your next moves. The wealthy mindset doesn't run from storms. They ready their sails. If you want to be part of that group, disciplined, alert, fearless, your journey starts here. If this video helped you see clarity in chaos, hit the like button, subscribe, and ring the bell so you never miss a market shift. And here's what to do next. Open your portfolio review tonight. Ask, which names are exposed? Which can hold? Which can you scale into if a valley opens? Drop a comment below with your biggest concern. I'll respond. Together, let's turn today's fear into tomorrow's edge. Stay sharp. Stay bold. I'll see you in the next video.